Disclaimer, $850 billion. That's not just some headline number you hear on cable news. It's not trivia, it's leverage. And right now, that leverage is being pulled away from the United States in real time. You see, the most dangerous problems in any financial system never show up where everyone is looking. They build up quietly, right under the surface, hidden by complicated accounting rules, confusing regulatory language, and constant official reassurance. By the time these problems make headlines, the real damage has already been done. Right now, the single weakest point in the entire U.S. financial structure isn't the stock market, it's not housing prices, and it's not even the dollar itself, it's the banking system. On paper, everything looks fine. U.S. banks appear stable. Their capital ratios seem okay. They pass their stress tests. Regulators keep telling us the system is well capitalized, but all that confidence is built on accounting tricks, not market reality. Here's the problem. Banks are holding massive amounts of long-term government bonds. They bought these when interest rates were near zero, thinking U.S. government debt was basically risk-free. But when interest rates go up, the market value of those bonds goes down. A lot. Those losses don't just vanish into thin air, they're just hidden. As long as banks don't sell the bonds, they're allowed to classify them as held to maturity, which means they don't have to officially report the losses. This little accounting trick only works under one condition. Depositors have to stay calm. The moment people start asking for their cash back, banks are forced to sell those bonds. And the second those assets are sold, the hidden losses become very, very real. This isn't just a theory. It already happened. In 2023, several major banks failed, not because they were making crazy speculative bets, but because rising interest rates exposed huge unrealized losses that they couldn't hide anymore once people started withdrawing their money. That whole episode was treated like an isolated incident. It wasn't. It was a preview of what's to come. Since then, interest rates have stayed high, which means the value of the bonds in bank portfolios has continued to drop. The hole has gotten deeper, not smaller. Every single time long-term interest rates tick up, it inflicts direct damage on bank balance sheets. This is why it's such a big deal when foreign countries start selling off U.S. debt. When large holders like other countries reduce their holdings, yields go up. Higher yields mean lower bond prices. Lower bond prices weaken the banks. This creates a dangerous feedback loop. Weaker banks lend less money. Less lending slows down the economy. A slower economy leads to more defaults on loans. And those defaults weaken the banks even further. The whole system just tightens on itself. In past crises, the Federal Reserve had some easy escape routes. They could cut interest rates aggressively. They could pump liquidity into the system. They could expand their balance sheet. They still have those tools, but using them now comes with a much higher cost. After the banking stress in 2023, the Fed quietly created emergency programs that let banks borrow against their underwater bonds at face value, not their lower market value. This stabilized things for a little while. But these aren't permanent solutions. They're politically sensitive, they cause inflation, and they're becoming more and more controversial. The more you use these emergency tools, the more they start to look like permanent policy. And the more that happens, the more people expect inflation to stick around. For years, the financial system had a hidden shock absorber, a ton of extra cash parked in safe places. That buffer is pretty much gone now. As that liquidity drains away, the system becomes brittle. Small shocks that used to be easily absorbed can now spread like wildfire. This is critical because U.S. treasuries aren't just investments. They are the collateral that underpins the entire global financial system. They're used in lending markets, derivatives, and international financing. When treasury prices fall sharply, the value of that collateral drops. Margin requirements go up. Forced selling begins. This is how volatility spreads, not through panic, but through pure mechanics. Modern markets are more interconnected than ever. Leverage is hidden everywhere. Trades are automated, and liquidity is much thinner than it looks. When stress hits, the reaction is instant. Decades ago, it might have taken months for a problem to cascade through the system. Today, it can happen in days, sometimes even hours. That's why bond market volatility terrifies central banks way more than stock market crashes. The stock market can fall without collapsing the system. The treasury market cannot. If confidence in U.S. treasuries ever breaks, the plumbing of global finance seizes up. For half a century, the U.S. dollar had a unique advantage. The world's energy trade was settled almost entirely in dollars. If a country needed oil or gas, it needed dollars first. This created constant, massive global demand for U.S. currency and U.S. debt. That system is slowly changing. Major energy importing countries are increasingly settling their trades in other currencies through bilateral agreements and regional deals. Every single transaction that happens outside the dollar system reduces the need to hold dollar reserves. And if fewer dollars are needed, fewer U.S. treasuries are needed. This isn't symbolic, it's a structural shift. Reserve currency systems don't collapse overnight. They erode gradually, bit by bit. until confidence reaches a tipping point. What makes this moment especially dangerous is the combination of forces all hitting at once. On one side, the supply of U.S. debt is exploding because of massive government deficits. On the other side, the structural demand from foreign buyers is weakening. This combination puts upward pressure on interest rates and downward pressure on the dollar. Currencies don't fail suddenly. They weaken, they drift. They quietly lose purchasing power. Then, when confidence finally breaks, the move accelerates. History shows us this pattern over and over again. When policymakers face impossible choices, they tend to pick the option that delays the pain. Inflation delays the pain. Cutting spending creates an immediate political backlash. Defaulting on debt creates an immediate crisis. Inflation spreads the pain out over time and across the whole population. That's why inflation is almost always the path they choose, even if they never admit it. When the Federal Reserve steps in to stabilize markets, they use careful language. They call it liquidity support, or improving market functioning, or ensuring financial stability. But the mechanism is always the same, creating more money. And once you start down that path, it becomes incredibly difficult to turn back. Rising asset prices don't always mean the economy is healthy. In an inflationary environment, markets often go up simply because the money itself is losing value. The nominal gains you see in your portfolio can hide real losses in your purchasing power. People feel wealthier, so they spend more, and that just accelerates inflation. Eventually, reality hits. Corporate debt gets refinanced at higher rates. Profit margins get squeezed. Layoffs follow. Markets don't automatically protect your purchasing power. They just delay the recognition of loss. For decades, investors relied on a simple rule: stocks for growth, bonds for safety. That whole framework was based on the idea that bonds would go up when stocks went down. But in an inflation-driven world, that assumption breaks down. Rising interest rates can damage both stocks and bonds at the same time. The traditional safety net disappears. This is why there's so much more uncertainty now than in past cycles. The old playbook just doesn't work anymore. When confidence in paper assets weakens, capital starts looking for something tangible. Assets that don't depend on promises. Assets that don't rely on a counterparty. Assets that can't be created out of thin air. This is why central banks around the world have been buying gold at historic rates. Gold is politically neutral. It settles outside the traditional financial system. It can't be digitally frozen. This isn't speculation. It's insurance. One of the clearest signs of stress is when the paper markets for an asset diverge from the physical markets. The price on a screen might say one thing, but the actual availability of the physical item tells a different story. Premiums go up. Delivery times get longer. Constraints appear. This divergence shows a decline in trust in financial promises. It's subtle at first, then it becomes impossible to ignore. No asset is perfect, of course. Real estate can protect against inflation, but only if you don't have too much debt. High interest rates turn that debt into a huge liability. Taxes go up, insurance costs rise, maintenance costs rise, and governments under financial pressure will increasingly target property owners because they are a visible and immobile tax base. Cash feels safe during uncertainty, until it's not. In a crisis, your access to your money matters more than your account balance. Rules can change. Withdrawals can be delayed. Liquidity can become conditional. Your cash is only safe if you can use it freely. We can't take that for granted. Central bank digital currencies are often pitched as a step toward modernization. In reality, they are about control, programmable money, instant policy enforcement. They can only work if alternative forms of money are limited. That's why having an exit matters, and why those exits are rarely kept open permanently. China's actions don't suggest panic. They suggest preparation. They are reducing their exposure to U.S. debt and the dollar system while increasing their holdings of gold, commodities, and physical supply chains. This is about building resilience, not chasing short-term returns. That distinction is crucial. Systems rarely just end abruptly. They transition. They go through periods of stress, adaptation, and restructuring. Wealth isn't destroyed in these moments, it's transferred. It moves from leverage to substance, from paper claims to tangible control, from complacency to preparation. The real danger is assuming the old rules still apply. Because financial systems are most dangerous not when they're collapsing, but when they are changing. And change rarely announces itself politely. That $850 billion isn't just a number, it's influence, it's leverage. And it is leaving the system quietly, methodically, and strategically. Everything you've heard so far leads to one unavoidable question. If China is selling, if foreign buyers are gone, if rates are rising on their own, where does the system break first? The answer isn't the stock market. It isn't housing. It isn't even the dollar. Not yet. The first fracture point is the banking system. And the damage is already there. It's just being hidden. On paper, U.S. banks look solid. Regulators call them well capitalized. But behind the numbers lies a $600 billion hole. Long-term government bonds were purchased when yields were near zero. Now, with rates surging, the market value of those bonds has collapsed. Losses that once were theoretical are now enormous, but banks continue to hide them by classifying them as held to maturity. This accounting trick works only as long as depositors remain calm, and when withdrawals accelerate, those losses are realized instantly. That is what triggered banking crises in 2023. And since then, the problem has only worsened. Every increase in rates deepens the hole. When China sells treasuries, yields rise. When yields rise, bond prices fall. When bond prices fall, banks weaken. Lending slows, businesses struggle, unemployment rises, and tax revenues shrink. This is how a banking crisis can quickly escalate into a sovereign crisis. In 2023, the Federal Reserve created emergency facilities to allow banks to borrow against underwater bonds at face value. That backstop no longer exists. The lifeline is gone, leaving the Fed trapped between two impossible choices: print money to save banks and destroy the currency, or refuse to intervene and watch the system break. There is no third option, and China knows it. For years, a hidden shock absorber in the form of the reverse repo facility cushioned liquidity stress. At its peak, it held over $2 trillion. Today, it's effectively empty. Banks must now fund deficits directly from markets with no buffer, just as China is selling and yields rise. Liquidity evaporates precisely when it is most needed. Stress will no longer build gradually. Modern markets are hyper-leveraged. Treasuries are used as collateral across derivatives, repos, and global funding markets. If treasury prices fall too fast, collateral collapses, triggering margin calls, forced selling, and systemic liquidity freezes. Flash crashes will no longer be limited to stocks. They can happen in the bond market itself. The petrodollar advantage that sustained the dollar for 50 years is eroding. Oil and energy are increasingly settled outside the dollar system, using yuan-based contracts, currency swaps, and bilateral agreements. This reduces global demand for dollars and, consequently, for treasuries. Less demand for treasuries directly undermines U.S. borrowing power. China is executing a pincer strategy against the dollar, increasing supply by selling U.S. debt while reducing demand by bypassing the dollar in trade. Currencies don't collapse overnight, but confidence erodes. Weakness grows slowly until a tipping point triggers a sudden slide. Politicians always prefer paths that delay pain. Inflation spreads the cost over time. Austerity triggers immediate backlash. Defaults are instant crises. This is why the Federal Reserve will eventually intervene again under the guise of market stability or liquidity support. And it will be money printing. When that happens, the dollar will weaken, assets rise nominally, and purchasing power will fall in real terms. Markets may appear strong, but real wealth diminishes. Rising stocks are not proof of health. Inflationary environments often push prices higher, even as underlying economic conditions worsen. People feel wealthier, spend more, and accelerate inflation unknowingly. Eventually, corporate debt refinances at higher rates, margins compress, layoffs begin, and reality catches up. Stocks do not shield against currency collapse. They merely postpone its recognition. The traditional 60-40 portfolio, stocks for growth, bonds for safety, no longer works. Bonds no longer hedge equities when inflation drives rates higher. Rising rates destroy both simultaneously. The safety net is gone. When trust in paper weakens, capital seeks tangibility, not promises, not projections, not yields. Reality. Gold is neutral, has no counterparty, and cannot be frozen. China understands this better than anyone. They are not speculating. They are positioning for a system where settlement is harder, credit is scarcer, and leverage is punished. If you can't touch it, you don't fully own it. Paper claims are only as strong as the system enforcing them. When systems strain, claims are restructured, delayed, or diluted. Physical assets do not ask permission. This is why premiums on metals diverge from paper prices. Two markets exist, one for paper, one for reality. Housing can protect against inflation, but only without excessive leverage. Mortgages become liabilities when rates rise sharply. Taxes, insurance, and maintenance costs climb. Municipalities under stress increase property taxes. The homeowner becomes the last resort financial backstop. Cash feels safe, until it isn't. During crises, access to cash becomes conditional, delayed, or restricted. Liquidity is only real if it is universally accepted and transferable. This is where central bank digital currencies gain appeal for authorities. Programmable money, restrictions, negative rates, instant taxation. They only work if people have no alternatives. China has already made its choice, reducing exposure to U.S. debt, dollar settlement, and Western custodians, while increasing holdings in gold, commodities, and physical supply chains. They are building resilience, not chasing returns. This is the clearest signal of systemic stress, a deliberate shift from paper to substance. Systems do not die quietly, they transform violently. Wealth is not destroyed, only transferred. From leverage to reality, from complacency to preparation. The storm is not coming. It is already here. The mainstream narrative that China could never sell U.S. debt without hurting itself has collapsed. Analysts, politicians, and central bankers have all misjudged the risk. The slow, deliberate exit from U.S. Treasury exposure is real, and consequences are visible in interest rates, housing, banking, and the cost of living. Treasuries are not merely investments. They are load-bearing beams of the global financial system. When the largest foreign holder walks away, cracks form everywhere above it. China is not passive. They are strategic. Their real exposure is closer to $850 billion when including agency debt like Fannie Mae and Freddie Mac. That influence, long dormant, is now active. For decades, this recycling of dollars into U.S. debt underpinned cheap credit, rising asset prices, and American lifestyles. Cheap foreign financing masked structural weaknesses in consumption, debt, and productivity. That lifeline is now being withdrawn. Geopolitics shattered the old system. Tariffs, technology restrictions, financial sanctions, and asset freezes sent a clear signal. Foreign reserves are not neutral. They can be weaponized. China took note and adjusted its strategy. The trend is unmistakable. China is exchanging paper for hard assets, accumulating gold month after month as insurance against systemic risk. This is not speculation. It is preparation. Paper promises are being replaced with tangible control. The U.S. government does not operate on savings. It relies on debt. Every deficit must be financed continuously. In the past, reliable buyers filled that gap. Now, China is selling, not buying. Supply is exploding just as demand disappears. The Federal Reserve, through quantitative tightening, is reducing its balance sheet. Banks are overloaded with government debt and massive unrealized losses. Japan is selling treasuries to defend its currency. Domestic investors, households, pension funds, banks are being forced to absorb the excess. To attract buyers, yields must rise. When yields rise, everything else fractures. Bond prices fall, long-term rates climb, mortgage rates soar, and housing affordability collapses. Transactions freeze, prices drop, consumption declines. The economy slows, banks feel the stress, defaults accelerate, the feedback loop strengthens. The Treasury has only two options: compel the Fed to intervene and absorb the selling through trillions of dollars of bond purchases, which weakens the dollar and fuels inflation, or let yields rise naturally, triggering banking stress, housing collapse, and a deflationary recession. Neither path is painless. China has created a dilemma that harms the middle class, regardless of choice. Official data misleads. Direct custody holdings suggest China still owns large amounts of U.S. debt, but indirect sales via European intermediaries have quietly reduced exposure. Selling pressure enters the market without leaving an obvious fingerprint. Every market rally becomes an exit opportunity. The era of ultra-cheap money is over. For 40 years, the U.S. borrowed cheaply because the world demanded its currency. That privilege is eroding steadily. Confidence cracks slowly, but once it does, higher rates become permanent. Debt service consumes more of the budget, political choices narrow, and social promises become unaffordable. This is not collapse. It is irreversible momentum. The storm is already here, moving silently through the financial system. If this breakdown helped you understand what's happening beneath the headlines, like this video, subscribe to the channel and stay connected here on Economic Records. When signals flash red, early recognition is everything.